Hello everyone, I'm glad you're here, because today we're diving into something that could impact your financial well-being in a big way. Let's talk about your money, and why you should pay attention to what's happening on Wall Street, even if you don't consider yourself an investor. Recently, Ted Pick, the CEO of Morgan Stanley, made headlines with a warning: the stock market could be heading for a correction. This isn't just another news story, it's a signal from one of the most influential voices in global finance. That word, correction, can sound scary, especially when you see people reacting with concern. But it's important to remember, a correction is a normal part of the market cycle, not a reason to panic or make rash decisions. Instead, it's a reason to get smart, to educate yourself, and to make sure you're prepared for whatever comes next. Morgan Stanley is a global financial powerhouse, managing trillions of dollars for individuals, companies, and even entire governments. Their insights shape the strategies of investors all over the world. When its CEO speaks, Wall Street listens, and so should you. These aren't just empty words, they're based on deep analysis and experience. Ted Pick isn't guessing. He's got access to the best research, the smartest minds in finance, and real-time data from markets around the globe. At a major summit in Hong Kong, he calmly suggested the market's been running hot for a long time and may need to cool off. This isn't about doom and gloom, it's about recognizing when things are moving too fast. Think of it like a car engine that needs a brake after hours at full speed. If you keep pushing, something could overheat. But if you slow down, you can keep going for the long haul. He's signaling a cooling off period, not a crash. Corrections are a way for the market to catch its breath and reset, not a sign that everything is falling apart. This isn't a time for fear. It's a time for preparation. It's your chance to review your financial plan, check your goals, and make sure you're on track. A warning isn't a guarantee, it's a heads up. It's like seeing clouds on the horizon. You don't cancel your plans, but you might grab an umbrella just in case. My goal is to help you understand what he said, what it means for you, and how you can protect and even grow your money, no matter what the market does. We'll walk through this together, step by step. I'll break down the jargon, explain the risks, and show you practical ways to respond. You'll learn the difference between a correction and a crisis, so you can spot the signs and avoid costly mistakes. You'll see how to be ready, whether you're just starting out or you've been investing for years. Preparation is key to weathering any storm. And you'll understand why a market dip can be an opportunity in disguise. Sometimes the best investments are made when others are fearful. You're going to be strong, secure, and in control. With the right information, you can make decisions that support your future and your family's well-being. Listen closely. This could make a real difference for your financial future. Even small changes in how you react to market news can have a big impact over time. The right knowledge is your best defense. It's what keeps you safe when markets get bumpy and helps you spot opportunities others might miss. Let's dive in and get you prepared. You've got this, and together, we'll make sure you're ready for whatever comes next. Let's break down market correction. It's simple. When a major stock index drops at least 10% from its recent high, but less than 20%, that's a correction. Think of it as the market taking a breather after a long climb. Corrections are normal and happen about once every year or two. Most are short-lived, lasting weeks or months. They help reset prices that have gotten too high, too fast. Corrections are caused by a mix of things: economic news, global events, or just overvalued stocks. It's like letting air out of an overinflated balloon. Don't confuse a correction with a crisis. They're not the same. Corrections are a healthy part of investing. Stay calm, stay focused, and be ready to navigate with a clear head. This is just one phase in the market cycle. Here's what Ted Pick actually said. He's not just tossing out a random number or making a dramatic prediction for headlines. He sees a possible 10% to 15% market drop on the horizon, a correction that could shake things up, but isn't out of the ordinary for seasoned investors. If the S&P 500 is sitting at 6,000, a 10% correction would bring it down to 5,400, while a 15% drop would mean 5,100. These are real, tangible numbers, not just vague warnings. This isn't a generic caution. It's a specific range investors can actually plan around, giving a sense of clarity in a world that often feels uncertain. Importantly, Ted Pick doesn't foresee a catastrophic event or a sudden crisis causing this dip. There's no talk of a massive recession or a banking collapse, just a technical, natural rebalancing after a period of strong gains and market enthusiasm. The market's had a fantastic run lately, especially when it comes to tech stocks, which have soared to new heights and captured headlines. When optimism is high and everyone's celebrating, prices can sometimes get ahead of themselves, setting the stage for a healthy pullback. Morgan Stanley's analysts see some areas of the market as getting a bit pricey, especially after such a strong rally. The message is clear: the market may need to cool off for a while, giving company earnings a chance to catch up with those elevated prices. This isn't a "the sky is falling" moment. It's more like a pilot announcing, "Caution, turbulence ahead," so everyone can buckle up and stay calm. Smart investors know that preparation beats panic every time. They review their portfolios, make adjustments, and stick to their long-term plans. So, check your seatbelt, review your investment plan, and get ready for a little bumpiness on the ride, because volatility is part of the journey. Remember, it's about being proactive, not reactive. Staying informed and prepared is the best way to navigate whatever the market brings next. One of the most important lessons for any investor is to know the difference between a correction and a crisis. This distinction is crucial because how you respond can make or break your long-term financial success. Many people confuse the two, but understanding what's really happening in the market can help you avoid costly mistakes. A correction is a 10% to 19% drop in the market. It's common, short-term, and part of the normal cycle of investing. Corrections happen regularly, often once every couple of years, and they're a sign that the market is adjusting itself after a period of growth. A crisis, on the other hand, is a bear market, a 20% or greater drop, usually tied to deep economic problems. Crises are rare, but when they hit, they can shake the foundations of the economy and investor confidence. Think back to 2008, not just a dip, but a collapse in housing and banking, leading to a global recession and widespread panic. In a crisis, the entire financial system can feel like it's at risk. Corrections are internal market adjustments, often triggered by profit-taking or short-term uncertainty. Crises, however, are triggered by major shocks or breakdowns, like a banking collapse, a pandemic, or a geopolitical event. Recovery from a correction is often measured in months, as markets bounce back and confidence returns. But recovery from a crisis can take years, requiring patience and resilience from investors. Ted Pick's warning is about a correction, not a crisis. He's signaling a normal, healthy pullback, not a catastrophic event. Don't react to a correction as if it's 2008. It's easy to let fear take over when headlines are negative, but overreacting can lead to poor decisions. A correction requires patience and discipline. It's a time to review your strategy, not abandon it. A crisis, on the other hand, may need a different response, sometimes rebalancing, sometimes seeking professional advice, and always staying informed. Understand the difference, and you'll avoid the biggest mistake: panicking and selling at the worst possible time, locking in losses that could have been avoided. Stay steady, stick to your plan, and don't let fear drive your decisions. Remember, markets have always recovered over time. This is how smart investors win. Keep your cool, trust your process, and let time work in your favor. Let's get personal. What does a 10% or 15% drop mean for your investments? Say your 401k is $100,000. A 10% correction drops it to $90,000. 15% to $85,000. That can feel like a gut punch, but you haven't lost anything unless you sell. You still own the same number of shares. Selling locks in losses. Staying invested gives your money a chance to recover. During corrections, you'll see a lot of red and scary headlines. Even great companies can see their stock prices fall. Corrections test your emotions more than your finances. Remember, you're investing for the long term. The people who lose money are those who sell at the bottom. The ones who build wealth stay the course, or buy more at a discount. Don't let fear dictate your actions. If a correction is coming, focus on what you can control. First, check your emergency fund, 8 to 12 months of living expenses in a safe, liquid account. This protects you from having to sell investments in a downturn. If you don't have it, make building it your top priority. Next, tackle high-interest debt, especially credit cards. Pay it down aggressively. It frees up cash and strengthens your finances. Finally, review your investments. Are you diversified? Do your holdings match your age and risk tolerance? Rebalance now, not in a panic. Preparation is power. Corrections are healthy for the market. Like a forest fire clearing dead wood, they reset prices and clear out speculation. They pop bubbles before they get dangerous. Corrections bring valuations back to reality, making stocks more attractive. This keeps the market stable and sustainable. Ted Pick says investors should welcome corrections. They're a feature, not a bug. They lay the groundwork for future growth. See corrections as a necessary reset, not a disaster. It's the market's way of cleaning house and preparing for new opportunities. The system is working as it should. Here's the opportunity. A correction is a sale for investors. Great companies go on sale, 10% to 15% off. If you're still saving, a correction is a gift. Every dollar buys more shares at lower prices. This is how real wealth is built. The key: keep investing regularly, no matter what. This is called dollar cost averaging. Don't try to time the bottom, just stick to your plan. When the market dips, shift your mindset from fear to opportunity. Be ready to put your money to work at better prices. Corrections separate smart, patient investors from the fearful. Be in the smart group. In the end, it's about your emotions. The market will rise and fall. You can't control that. What you can control is your reaction. Ted Pick's warning is a reason to prepare, not to panic. Stop watching the daily noise. Don't check your balance every day. You're a long-term investor. Focus on your future, not today's headlines. Remember your why: financial freedom, security, and peace of mind. A short-term dip is just a bump on the road to your goals. Trust your plan, not your fear. Take a deep breath. You're ready for this. You know what a correction is and how to handle it. You have a plan and the discipline to stick to it. You're in control and you're going to be just fine. Stay strong, stay smart, and keep moving forward.